Hi, it's Josh Sussberg from Kirkland Ellis, and welcome to day 3 of the Distressed Investing Conference. We hope everyone has enjoyed thus far, and we've got a great day of speakers and panels to round out the program, which is admittedly a little bit different because, as you can see, everybody is sitting in the comforts of their own homes. But we appreciate everyone participating and hope you found it informative and educational. I have the distinct honor and privilege of being able to introduce my partner this morning, who is going to start us off with the opening remarks. There's very few people in the distressed and restructuring world that are known solely by their first names. And I could say wholeheartedly that Jamie Sprayregen is one of those. And so I am honored to have Jamie begin the day off on an important day in the history of the United States. It happens to be his birthday as well. So I'm going to kick it to Jamie.
Thanks, Josh. Much appreciated. And thanks, everybody, for having me. They've given me 10 minutes here to just give a few opening remarks. So I'll be kind of quick. We all know this has kind of been a terrible year. A friend of mine from New Orleans told me a not so funny joke that a guy walks into a bar in New Orleans and says, can I have 3 hurricanes and 1 Corona? And the bartender gives it to him and says, that'll be 2020. And so that's a little bit where we are this year. But this is an auspicious day, not because it's my birthday, but on a more optimistic note. Obviously, we all know a vaccine's been approved in the UK today and hopefully imminently in the US. And so I thought maybe I'd be a little bit more optimistic and talk about a few things. And maybe the way I put it with the vaccine coming soon, hopefully, is a famous Winston Churchill quote after an early battle in World War II, where he said, "This is not the end. This is not the beginning of the end, but it's the end of the beginning." We're going to all have a pretty rough winter, health-wise, maybe not professional-wise, and so I wish everybody luck getting through that. But I will say, if you step back in our industry, I wanted to focus real quick on what I call sort of the 10 things that didn't happen that really give me a lot of optimism for our industry and going forward, kind of once, unfortunately, we get through this tough winter. So what are those? First, when all this hit, a lot of people predicted Armageddon. The system didn't collapse. And that could have happened. Obviously, if the government hadn't stepped in with $2.5 trillion, maybe it would have made a big difference. And who knows what would have happened. But the system went on. So that was my number one. Number two, bankruptcy courts. They really stepped up. A lot of people thought, how are we going to do what we do? And the bankruptcy courts aren't going to work. But it did work. Everybody went to the Zoom hearings and not just step into the podium, but trials and witnesses and et cetera. And that all kept working. And so I'd call that a win. We'll see how that, there's a lot of suboptimal parts to it, but parts of it I think will last with us going forward. Number 3, settlements kept happening. We all talk about settlements on the courthouse steps or the hallway and all that. And it's been more difficult, but we still have been able to get a lot of things done, notwithstanding, and we found different ways to get settlements done. So I'll give credit for that. Number 4, professional firms, law, consulting, bankers kept working. Who would have thought that you could have said you're going to be 99%, 100% out of your offices, not see all of your colleagues and partners and people you work with, and that the system would keep working the way it did. But professional firms kept working and, in fact, actually worked pretty good. Number 5, the financial system itself, capital markets, debt finance, the hedge funds, the big banks, things just kept working. You actually have ended up with record issuance of leveraged loans and high yield in 2020 compared to any other year. Now, again, you could credit that to the largesse of our Treasury and Fed, but it happened nonetheless. Number 6, subset of that, but incredibly important subset. When this hit, there was massive draws on revolvers, tens of billions, probably hundreds of billions. I haven't added it up, but that worked. The system, what I call it, did not work, or sometimes I call it the sound of the dog not barking. And that's incredibly important. Back in the GFC, there was a lot more questions about whether all those draws were going to be honored, and a lot of lobbying actually by big banks to stop those draws. And some of it actually happened. Here, it was actually pretty smooth. Number 7, business development, networking, just talking to people, obviously a lot harder for everybody, but that's gone on. Everybody, I'm sure, has been on lots of Zoom calls and different ways of doing things. And, that kind of kept going. And so that didn't come to a stop. Number 8, training, education, what we're doing here today. I understand there's about 600 people on this session. I've been on ones around the world, and that didn't grind to a halt. People were thinking, how could you do that? And better yet, this one's free, I understand. So a little bit benefit to that. But I've even seen increases in attendance, and attendance from lots of places that wouldn't happen if you had to be in person, people coming in from around the world. So to me, that's been an incredible positive. Number 9, and this is where I get into thinking about, what's 2021 going to look like. The business cycle didn't stop happening. Obviously, early on, we had a ton of retail and energy cases. I think some of that were a lot of companies that were going to end up filing anyway. I've heard somebody say we took a 5-year restructuring cycle and shoehorned it into 3 to 6 months. And there's some truth to that, at least with some of the industries. And so, that the cycle kept going on. Where is it going to go from here? I don't really have that much time to address that, but I've been relatively bullish on being bearish for everybody on this session that we're going to have a decent amount to do in 2021. I have less conviction about that, I have to admit, than I had 3 to 6 months ago with volatility coming down and vaccine coming in. But companies have taken on a massive amount of debt. And while their earnings capacity on a number of them has gone down, and while I don't think we're going to have the same type of thing we had in mid-March and April, there's just going to be a number of companies that are going to need help because they can't grow into their capital structures. And you'll see a number of debt for equity swaps, the bottom layers of the capital structures eliminated, the usual pushing and shoving about where value ends. But I think there'll be a decent amount for us to do. Although I'm always cognizant of not talking my own book. And I always quote the joke about the economists who've correctly predicted 9 out of the last 5 recessions. So we got to be a little bit cognizant that that may or may not happen. And I know the next panel will talk a bunch more about that. And then number 10, and I'll end it on this, this industry has been incredibly generous and charitable in a number of areas over the years. And good to say that didn't stop happening. I think I'm involved in a number of organizations. I'm sure many of you are. And I think there was terror going through all of the organizations and earlier in the year about how are they going to continue their fundraising, et cetera. But it's again been suboptimal. There's been a lot of virtual events, but this industry has continued to step up and contribute and give back, and I'm actually very proud of that. So I would say, obviously, there's a lot of tough stuff to go through, and I'm not focusing on the health side of things, which is I wish everybody safe and sound on that, you and your families. And in our industry, while it's been incredibly tough, I think there's a lot of optimism in the way the system's handled it, and that we'll all have things to do in 2021. So sort of happy early holidays to everybody, and I'll turn it back to Josh.
Thank you, Jamie. That was great. Good insight. Much appreciated. I am now going to turn it over to our Investors Roundtable. We've got a great group of investors that are going to share some insight into the markets and what we're seeing and what's to come. The panel is being moderated by Steve Gidumal, who you guys all heard from just 2 short days ago. So I will leave it to Steve to introduce the panelists and kick us off from an Investors Roundtable perspective. Thanks, Steve.
Thanks, Josh. I hope everybody can hear me. Megan, please let me know if you can't. I'd like to introduce my panel members. I see Gary Hines showing up on the screen there. Gary Hines is managing director of the Delaware Bake Company, and I have it on complete authority. He has actually been in Joe Biden's basement, as Gary was once head chairman of the Democratic Party of Delaware, if I recall. So he knows. He probably knows all these people, and that's going to help me stay out of jail the next 4 years. So I appreciate that, Gary, and he's promised to do that. We also have Matt Dundon, who I've had the pleasure of working with on a couple of deals, and Matt has created a firm called Dundon Advisors, which is just blown it out of the water right now in terms of business and success. And I encourage all of you to that need some sharp financial and consulting minds to, if Matt's got availability, to consider him. Then my good friend and managing director at ODEON Capital, Richard Fels, who I've probably known over 25, 26 years now. About the same length time I've known Gary, actually. And he is managing director and is a consummate trader. And then we had our other friend, who I'd just like to mention, even though I guess we removed him from the panel here, Dave Miller, senior portfolio manager for Elliott Management. And he's had some audio problems, and he's also attending a board meeting this morning, which has probably contributed to his audio problems. And he may join us later, but if he doesn't, we're all in good hands. So I'd like to start with Dave's slide, Dave Miller's slides, which is the COVID. It's analyzing retailer struggles. And this, I'll kick it over to some of our panel members in just a second. But the concept of this slide was that we want to just talk about the retailers in general. And there is, while obviously there's a revenue fail on many of the retailers because of COVID, at the same time, a lot of these retailers have already transitioned to online services. So you can't blame all of the lack of sales on the simply on the fact that people can't get to stores, because we all know, obviously, Amazon is going gangbusters. So one of the things I want to throw out to the panel, if there's any retailers that come to mind, and this, again, this was really something Dave wanted to talk about, that have broken business models, or that have misunderstood their changing customer patterns, and is that as much a reason for their failure as the COVID? Dave wanted to make the point, and which I concur with, is that there's a lot of capital available, and Jamie Sprayregen just mentioned that how the market stepped up. But you look out in the market right now, the spreads are very tight, 300 basis points between the short end and the long end of the curve. It's actually even tighter on the government side. It's about a point. And the distressed, the high yield market is within 300 basis points, probably some of the tightest spreads we've seen in our entire business. So people willing to, markets are open. I mean, you could take a bond offering to the market, at any time, right, in this market, and find plenty of capital. So it still is a world flush with capital, and that makes opportunities very achievable for the right kind of retail concepts. So with that, I'd like to maybe, and then of course we still have the Amazon effect. So let me ask Matt Dundon if are there any? Can he think of some retailers that, in his mind, may have slipped up from a standpoint of a broken business model or misunderstanding the changing customer patterns, or are there some retailers that it's just simply a matter that he knows of that if they would just access the capital, there's capital available for them? Matt?
Hey, Steve, thanks. So we've been involved in and continue to be involved in a lot of distressed retailers from a variety of capacities in our asset management and our restructuring business. I think Jamie Sprayregen in his introductory remarks noted something very thoughtful that a lot of what we've seen in the Chapter 11s and out-of-court restructurings over the past 9 months has been an acceleration of trends that were already in place. Weak capital structures and secular as opposed to cyclically bad businesses. Casual dining was very unhealthy. Inline mall-based retailers were very unhealthy. JCPenney and Neiman Marcus were very unhealthy, and their bankruptcies. I don't know if you would use the word inevitable, but in most cases they had capital structures that didn't make a lot of sense. And what COVID did was just sort of put an underline on that and said, look, what's inevitable is going to happen now. On the flip side, we've certainly seen that there have been some true COVID-triggered bankruptcies that people kind of could get inside of and figure out, hey, this made sense. This company has a reason to exist in its current capital structure. One name we were involved in is an outfit by the name of Tuesday Morning, which filed for bankruptcy and is now going to have a money good recovery and a significant dividend to equity. And in part, that's because people recognized that they sold among other things, sold products that are not sort of easily transitioned to Amazon, easily substituted away. On the flip side, you certainly have the market ambivalent about sort of secular transitions and recovery. And when we think about that in the retail space, I think that's most acute with respect to movie theaters, where on the one hand, we have seen significant capital come into the movie theaters, been able to raise money primarily at the secured level and a couple cases at the unsecured level. We have AMC, which at the lows of its capital structure before the virus news had second lien bonds trading barely in the double digits, was still able to issue better part of $100 million of common stock in the marketplace and has its common stock price only down 40% year to date, while it has bonds trading in the 10s and 20s. So when we think about investment opportunities, one thing, and it's harder to do in a lot of capital structures, is to think as an arbitrageur, right? You look at, just to come back to AMC because it's a big multi-tier capital structure. The one thing you know about AMC's capital structure is that it is mispriced, right? It's hard to say exactly what's mispriced. Are the studios going to come back and give hit movies? If they are, then you really want to be in the movie theaters, from the second half of next year through 2022, because Hollywood production shut down for really about 4 months. But the movie theaters are going to be closed to tentpole releases for solidly 12 months, right? The plug was pulled on April 1st, and we don't have a confident, true commercial expected to be hit movie release due until late April of 2021. So call that 13 months, potentially moving out to 14 months. There could be a big new movie once or twice a week for a year solid. And that gets to a bigger point when we think about this, right? Once again, Jamie kind of used the famous Churchill quote, not the beginning of the end, but perhaps the end of the beginning. I think about darkest before the dawn, right? And that is really where we're at. And if there's the investable structure is one that has some sticking power. So I don't look at things that are teetering on the verge of bankruptcy. I look at things where you could say, if I'm a pure secondary investor, this thing has enough liquidity to make it 6 to 8 months. And to me, that is the key measure of something that is investable in retail now. Is it's not fundamentally like if office space never gets back to, in core cities, only recovers to 70% of 2019 levels, like, does this company still have a reason to exist? And does it have the liquidity to make it through what could be nationwide shutdowns, comparable level of where we at in April over the course of January and February, and then emerge out with a vaccine on the other side? So to me, that is a critical thing, because if you're going to need new money to come in January or February, if you're not poised to provide that new money, if you're the person who's seeking it because you bought some bonds but you're not able to write a big check and drive the bus on a recapitalization group, you want nothing to do with that situation, because there will be dilution, there will be bankruptcies that will shut you out, and you're not necessarily going to have the tools in court, right? If Josh Sussberg is sitting there as debtor counsel, no matter how much he might believe in the company, he's like, here it is. The lenders need to do an auction within 2 months. If you don't step up and outbid the lenders, they're taking everything and leaving you with, 2, 3, 4, 5, 6% of the equity. We just finished up Tailored Brands, and unsecured creditors are taking out a small slice of the equity and ultimately feel pretty happy that we were able to get that. If the lenders are right, a year from now, it's going to be every wedding that was delayed. They're going to be renting tuxedos. They're going to be making money hand over fist, and they're going to be very happy where they came in. But the time wasn't on our side, so that's the trick: is looking at people with time on your side. Movie theaters, I think, are a good example of something that has time on its side. Inline mall-based retailers, it's a little challenging. I'd look for end cap names that are still in a sold-off position, because they're less dependent on that mall traffic recovery. Because malls are one of the things that could get shut down again, and I guarantee you, there's probably a better point of entry for any kind of mall-based retailer at some point in the next 2 months than there is today. In terms of capital availability, I will 100% agree that it's out there, but at the level of distressed restaurants and retailers, it's not out there at attractive terms. The market is pretty binary, right? If you tick the box of eligibility, you can issue at incredibly low spreads. The market will whistle past the graveyard of anything that threatens you. But if you're an inline mall retailer, that capital is not available to you. And so unfortunately, in the tale of two cities, you're in the bad city, and you need to look at the internal sources of liquidity for that name that are in place, that are contracted, that can't be taken away for at least 6 months. And that's an interesting one to sort of make your darkest before the dawn trade.
So Matt, let me just jump in here. Just going back on a couple things. Tuesday morning, you said had products that were resistant to Amazon. What? I'm not familiar with that chain. What kind of products were they? What do you think you have to touch?
So it's a housewares company, right? That had the treasure hunt model. So if this is a little esoteric for people who aren't retail specialists, but there are a bunch of different chains in the company in the country that have merchandisers that in theory go around the world. They look for interesting products that are typically housewares of some form or another, furnishings of some form or another, small footprint furnishings. And the point of that business is it's fundamentally, you're walking down the aisle of the store and you see something you like that you didn't know you were looking for, right? Amazon is terrible for browsing. A lot of book lovers will tell you, for them, the greatest loss of having big bookstores in lots of locations was the serendipity of finding a book that you didn't know you wanted until you picked it up off the shelf and read the flyleaf cover and said, that's great. So this was a retailer driven by that. And so ultimately the market, I think, was able to discern that this is a business that it's not an inline mall business. It's not something that is going to have a permanent, irrevocable loss of share to online shopping. And therefore people ultimately were willing to take a step back and start to reinvest. And that company ultimately had I don't think a bidding war is the right word. And in the interest of full disclosure, we represented a bidder who was looking to buy the company. But the deal was financed primarily through an infusion of new equity and new subordinated debt. So people were willing to come in at the bottom of the capital structure because they saw that. And I think.
Were they a mall retailer or a?
No. They're big stores that can be in parking lots of malls or can be in their own locations. Yeah, like look, I don't think, and people on the panel might correct me if I'm wrong, I don't think we've seen an inline mall-based retailer or an end cap retailer, right, get a significant new infusion of risk capital, right? That's not been how Tailored Brands or JCPenney or Neiman Marcus have worked out. Right, they are, new money is coming into those concepts at, if at all, at the top of the capital structure, and the primary driver of the restructuring has been equitization of the fulcrum layer of the capital structure, whatever that might be. People are very much not taking big cash bets on the outcome of those companies, except under very narrowly tailored circumstances where they look at the incremental cash as having a very positive, what we call cash on cash recovery. But for the most part, the primary source of the new structures is just equitization. I think people feel that way about restaurants, particularly sit-down restaurant chains. I think they're regarded, as very dangerous, and there's a very limited appetite to put new risk capital into those things at any kind of multiple that's attractive to an existing investor.
So let me bring Richard Fels in here at this time. And Richard, do you want to comment on either inline mall retailers and what you're seeing?
Rumors at what? I'm sorry. Rumors at what? I missed you there.
Richard Fels. Hello. Yeah, I'd like to bring in Richard and see if he could comment on, add to this on the
yes,
on the mall business or on the retail.
I'm here. So, Matt, as an extension of what you're saying, is what I watch is consumer patterns and habits, and they have been sped up with COVID. And a great example is earlier this week, Christina Hart in her panel came to a conclusion that the mass merchants.
No, I read it, but I didn't watch it. No.
And one-stop shopping providers have a bright future. So we'll see names like Walmart, Costco, Home Depot, and the like continue to gain market share from the smaller regional players. I think that's the future. There could be an exception of hometown buying. I live in a little town called the Village of Ridgewood, and there's a big effort for people to shop in the independent stores in town. Yeah, but there are only 20 stores. I think you can take these changing and shifting consumer patterns and habits and take this idea one step further in a post-COVID growth case for the cruise lines.
Cruise lines.
Families, individuals, seniors like the concept of one-stop vacationing for the whole family or the competitive hobbyist. I don't know if we can actually make that case for theater companies because of the tremendous growth in Amazon Prime, on Netflix, Hulu, and free. I mean, they seem to be popping up. Disney all have their own channels. But I like the extension for the cruise lines. Because go ahead.
Sure. Can they survive till next year?
Oh, definitely have raised so much debt. They have plenty of liquidity. Can they grow into their cap structure? Like Jamie said, different issue. Different issue.
I think there's a great pivot for people to go from thinking about retailers to thinking about travel and transportation and leisure and entertainment. Right. So liquidity seems solid for the cruise lines as well, as long as they can get back into business for the late spring, summer cruise season. Right. So there, I don't know if there's one cruise company that is really funded to be shut down through next summer. And so there is a lot banked on implicitly or explicitly on a vaccine. And the question you have to ask is, are you being compensated for that risk? Right. So I think you'll hear no objection from me that Costco is a great company and Costco's share is probably going to grow. But Costco's stock is an all-time high, up 50%, 30% year to date. From a standpoint of a distressed investor, you would look at Costco as some kind of deep out of the money downside hedge, right? You short some Costco in case the world truly falls apart. If you could find a safe place to put on a short in that structure. The cruise lines need, one can argue they're a better play than an airline because the airlines have a reliance on business travel that may not come back, right? And then this is something that we've all been talking about when we think about airlines and the higher end hotels is, our Zoom court hearings for those of us who play on the restructuring side. Are we ever really going to have a bankruptcy judge in Houston say, I need 40 people to get on planes from New York, Chicago, and Wilmington, Delaware, and fly down to Houston for a 1-hour hearing, right? When it turns out that we could have those same 40 people on Zoom, and we could save the estate $250,000 for the cost of that hearing, right? And that hearing just went from $250,000 to $40,000 in costs. Does that ever come back? Do big conferences ever come back? We put all of our firm's conference budget into holiday gifts and things like that, as I think a lot of other people have done. I'm not sure that there's a lot of appetite. Beautiful thing about the cruise lines is they never had any of that, right? Pure leisure. So I think for them, it's a binary bet on are people coming back in by April or May. And they need to be, remember, it needs to be in place. People don't make cruise reservations the day before. It's not a spontaneous decision. We need people and regulators to feel safe by April. I'll turn it back to movie theaters. I think people like going to the movie theaters. Hollywood absolutely cannot replace theatrical revenues with streaming revenues. Like, the math does not add up, right? For a hit movie, the theatrical revenues are extraordinarily powerful, and there's no evidence that people are going to be paying a remotely equivalent price on sort of premium video on demand. So
Matt,
you don't have to be quite as right to get people back into movie theaters, and movie theaters don't have quite the same level of costs that it costs Carnival to lay up a cruise ship.
So Matt, I agree with that, but if you take a look at what Disney has done and created their own streaming service, they've already looked into their crystal ball, and they already see that the theater attendance historically is going to be decreasing over time. I don't know how the future will play out for the big budget productions being shown in movie theaters. I am sure that it will be around for quite a while. Just to go back to the airlines, a little point, Thanksgiving travel was down 60% as these airlines continue to suffer from the biggest event that they've ever engaged in. But conferences, you're right. But I believe that the first salesperson that gets on a plane and goes to a client and gets a deal done, makes a sale, gets an assignment, you'll see everyone else getting on a plane and visiting their clients to get a deal done. For a court appearance, flying down to Texas, maybe you don't need to do that anymore. And so
let me jump in here right now. I just wanted to I'm sorry, Richard.
So let me just throw out one thing. Maybe we can move on to some of our other topics. I know we want to talk about GSEs, which I have nothing to say about, but I know you guys want to talk about them, and the audience cares intensely. Just one last thing. It's about relative value, right? So let's take Carnival Cruise Lines and AMC Theaters, right? Carnival Cruise Lines right now will pay you 3.5% yield on their first lien debt, pay you less than 6% yield on their unsecured debt, right? That is a capital structure that is what we like to call price to perfection. Like, you really have to believe that thing is right, whereas, you can buy, 14%, 15% first lien debt in AMC, and you can buy unsecured bonds for 19 cents on the dollar, in AMC. So when you're thinking about this darkest before the dawn point of entry, right, I think you really do have to consider what are the names where the cost of capital has come flooding back in, and does that make any sense, right? Because, are you being paid in Carnival Cruise for the risk that they're not going to be allowed to cruise this summer, right? And I think at the unsecured level, you are clearly not being paid for that risk at 6%. Maybe the first liens are covered because you can find somebody to buy buy all
Let
the
me-
ships. Even if worst case worse, there's somebody who will buy them and lay them up to cruise in 2022. But I think that's the key thing. Steve, do you want to take it over to the GSC so all the GSC nerds can have their day in the sun?
I was just going to say one other thing on the movie theaters. The only thing I've been able to duplicate in my home that equates to the experiences I used to have, 8 months ago, is a home movie theater where, with the quality of these new TVs, I put something up in a wall in a theater room, and the other day I was watching a movie, and I swear I thought the quality on my home TV was higher than I would have seen on a screen in a movie theater and a big screen. Obviously now they got the 84 inchers and you got the theater seats you can, put in your home. And I was just thinking about it. It's like, I don't know why I would ever go to a movie theater, given that how exceptional the quality is becoming on these HD4, TV types. So, they always say capitalism, the best thing about it was, or the best and worst thing about it was the constant cannibalization of various products. I would be a little nervous about the movie theaters. And keep in mind, when you talk about the gross revenues, they're only keeping about 50% of their ticket sales because they got to give the other, 25 to 50% back to the theaters. But with that, let's just transition to our next slide, Megan, and which is the GSEs. And here, one of our, we have actually one of the primary players in this area is Gary Hines. And Gary, you want to kick us off here on how you see this this folding out?
Well, we're really at a crucial inflection point because Calabria has indicated that he would like to get these guys out under a consent agreement. And a key thing that we're looking for in the next few weeks, probably a month, is the government has got to renegotiate the preferred stock purchase agreements because there's a cap on how much money they can retain in earnings, and they're making enough money that they're going to blow through that cap. So that cap is at the very least going to have to be increased. But the more important thing is, will the government finally admit that it has been paid back in full, which is a key thing that must be done if they're going to be able to raise capital next year in the capital markets. Nobody's going to put any capital into these companies if the government is taking all of the profits for itself. So that's a crucial thing that should be happening in the next, I would say, 4 to 6 weeks. Also, December the 9th, there's going to be a hearing in front of the Supreme Court on the legality of the net worth sweep, and also whether Mark Calabria can be dismissed at will by a President Biden. The odds do not look good for the government in either of those cases. So, we're getting to push comes to shove point at that. And I think one of the things that's hanging up the admittance that the government has been paid back in full, and they have been, they advanced 191.5 billion, and I believe they've collected over 300 billion now. So they're, the numbers are what the numbers are. But you have all these anti-GSE people out there saying, well, you're just trying to benefit a few hedge funds at the taxpayers' expense. Well, the fact of the matter is, this has already been, if you look at the numbers, this has already been the best deal for the taxpayer since the Louisiana Purchase. Not only has the taxpayer, made well over $100 billion already on this deal, but something that people overlook is that the taxpayer and the government never put up a penny to, quote, bail out Fannie and Freddie. Where did the money come from? Where all the rest of our deficit spending comes from, the bond market. The government went out and borrowed 191.5 billion from the Chinese and the Japanese, but primarily, and the rest of the bond market, at well less, I'm sure, than 3%. And they turned around and they loaned it to Fannie and Freddie at 10%. So think about it. without putting up a dime, the government has been earning what 900 basis points on almost $200 billion for 12 years. I mean, it's been a hell of a deal. And I think that if I were Mnuchin, that's the way I would sell it when I decide that we finally have to admit that the government has been repaid. So I think things, I've always said that the backup on this is the lawsuits. There's no question that this was not a bailout. It was a stick up. In fact, just in the last 24 hours, some of the redactions in one of the complaints, the Washington federal complaint, have been lifted. Remember, there's 11,000 documents that are under seal that the government has said, oh, we can't release those because it could cause another financial crisis. Bullshit, of course. But in the last 24 hours, some of those things have been lifted, and it just confirms this was not a bailout. It was a stick up.
So, Gary, if you mentioned the question being tried at the Supreme Court level as to whether Calabria can be dismissed, if it comes back that he cannot be dismissed, which it sounds like you think is the better side of the argument, will that delay? Would that make it less urgent to get this done before the Trump administration, unwinds, or would that give people rooting for an agreement here more time?
Well, there's two pieces of that. The first piece, which is renegotiating the PSPAs and declaring them the government's preferred stock paid in full, that has to be done by Treasury, and that will be done by Mnuchin, I believe, before he leaves on January the 20th. Once that's done, that can't be undone by a future administration.
Let me stop you again. What do you think Mnuchin is going to do before he leaves? Say that again to the audience.
Renegotiate the preferred stock purchase agreement with the government and basically say, we have been repaid in full. They need to do that, as I mentioned, for two reasons. The first one being they're bumping up on the ceiling. And secondly, they want to raise money. They want to bring private capital ahead of the government here. You can't do that if you just simply cannot do that. So that's the first thing that has to happen, and that's more important than Calabria. Calabria could then, if he wants to, release them under a consent agreement before he leaves office, which you know how those things work. Basically, they can't be undone by a future administration. But by the way, in terms of a future administration, I think some of us have got to root for actually Calabria leaving, because Calabria has saddled them with a 4% capital ratio, which is crazy. Out of 167 responses to his proposed 4% capital ratio, I think all but 4 said, including for the mortgage bankers and the American bankers, said this is way too high. And I think one of the first things you would see done by a Biden appointee to head FHFA is to bring that capital ratio down significantly.
That makes it less unstable, doesn't it? Less stable, rather.
No, quite the contrary. First of all, whatever the ratio is, they're simply going to add it to the cost of mortgages. So if you want housing to be a big promoter of economic growth, clearly you can't have a mortgage rates which are onerous.
Okay, fair enough. And so just since you brought up the new administration, what do you think Biden and Yellen's views would be about getting a GSE deal done? And maybe
I have so much on the plate right now that
what's that?
I think there's, with a wink and a nod, it's just let Calabria and Mnuchin get this done. We have too much to worry about on our plate as it is. And by the way, the final thought I would leave you with is about 4 years ago today, Mnuchin said, we've got to get them out of conservatorship and we're going to work on it. And we're going to get it done relatively fast, blah, 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 blah. Well, I don't believe that they've gone as far as they've gone and that Mnuchin and Calabria are going to drop the ball on the 1 yard line. I think they're going to get something done.
What would you say the odds of that are? 80%, 90%?
I would say 75 to 80, if not higher. I mean, it's hard to put odds on something like that. I mean, I would say even
We do that every day.
I mean, I just don't. I cannot see Mnuchin leave an office with this unfinished.
I see. Okay. Hey, let me jump to Rick.
Gary, let me play the peanut gallery here. Is there still a trade?
Well, I think so. There's certainly a trade in the preferreds. I mean, the preferreds are trading at. I haven't looked at them this morning, but they're less than 50% of par. I mean,
yeah, there's still a trade.
Absolutely.
Yeah.
So the trade is by the preps, not the common.
You know what? I've been kind of agnostic on the common. I think the common probably is a buy. Remember, the government owns 79.9% of the common. And, for every dollar that the quote hedge funds make or the current holders of common make, the government makes 4 because it owns 80% of the, 79.9% of the common. I think the common's probably a buy, but I mean, when you can look at something, doubling your money in probably a year, that's good enough for me.
Let me bring in Richard on this. Richard, how do you see this?
Gary has been right. He is absolutely right. I would continue to recommend being involved in the preferred. As far as the equity, I would trade it opportunistically until you start getting some clarity. But there is value here in the preferred. It's trading at a deep discount. You can even buy off the runs at a discount to the on the runs, and that is a separate play. There's no one I know that is deeper in the weeds than Gary on the GSEs. And he makes a lot of sense.
Great. Okay. And,
maybe deeper in the muck.
and in the weeds. And Richard, you're not worried about the extensive capital raise that's going to have to be done at the equity level, affecting the common?
No, because capital is plentiful. People are going to want to be involved.
In terms about the pricing, what the pricing will do to the common. What the amount of capital will do to the value of the common, the price of the common.
Well, that's why the common is trading. The common will go through a massive reverse split or something to make it a normal, price. The common should start trading at $10, so to speak. It needs to trade at a real number so that the indexes, the ETFs, all of these people that are going to want a piece of this.
No, I agree with that. The reverse strip split will be mechanical. So go ahead, Gary.
That brings up another point, and that's that at some point before too much longer, they're going to have to relist these stocks. You can't raise capital with the institutional market with stocks that trade in the pink sheets.
Agreed, Gary. And remember, the GSEs, they own 92% of the market.
Yeah,
they would be happier if they only owned 80%. But that's going to take a long time.
I see what you're saying. Yeah. So before we go to the next topic, let me just throw this out. We have about 15 to 18 minutes left, and if there are any questions, people can just, text them to us, and then we can take maybe 5 minutes or so questions at the end, or 5-10 minutes. Gary, Richard, Matt, anything you want to add on this GSEs? Or we can turn the page on this? Okay, so why don't we go to the next page? Let me ask, since we touched on a couple of these. Matt, last year you had mentioned Anthem as an indicator of who's going to win the election. You want to give us an update on Anthem at this point? I mean, I think has the stock traded off now with the Biden election, or is the Senate situation keeping things, basically okay for Anthem?
So, hey, Steve, that's great. So obviously, what we were saying was last year was you're not being compensated for the risk in these capital structures that that Bernie Sanders or Elizabeth Warren is going to be the next president of the United States.
Excellent.
And, if you took the other side of that bet, you won, because the corporate establishment rallied hard behind Joe Biden and was able to get past Bernie Sanders, and Joe Biden is president-elect with a, what I would say is a moderate, a significantly progressive Democratic platform that he's probably committed to a limited extent. And then he is further constrained by the Senate being likely to retain a Republican majority. And even if the Democrats win both seats in Georgia next month, it'll be a 50-50 Senate with a nominal Democratic majority through Kamala Harris's tie-breaking vote, but the committees will be equally divided, and significantly pro, let's call it corporate healthcare industry Democrats like Joe Manchin will be holding the deciding power. There simply is not a sufficient Senate majority to jam through aggressive reforms. I think that the market, if you are an operator of facilities, I think you're pretty happy. If you're a pharma, I think we take the view that drug price reform is going to happen in some form, probably not the most aggressive form, but it's going to happen. And so, overall, I think Washington is set up to send more money into the healthcare system, right? They want people to have better healthcare and cheaper healthcare, but they don't really have the political resolve to take it out of the hides of the healthcare industry. For the most part, they're going to take it out of the hides of the taxpayer and future taxpayers by way of continuing to run gigantic deficits. So, I would be pretty happy to be a provider these days, especially at the facilities level, especially at the medical services provider level. I'd be a little more cautious as a pharma, but I wouldn't be, I don't think that there's likely the political will or more importantly, wherewithal to drive through a dramatically bad resolution on drug pricing. Now, there are going to be some issues. We're going to set up, I think that the outgoing Trump Health and Human Services is setting up a little bit of a fight on what's called most favored nations. It's a drug price regulation that would in theory require drug makers to sell U.S. payers drugs at the same price they're selling to the health ministries and other health buyers in foreign countries. The industry naturally doesn't like that one bit, because they get paid more to sell drugs to Medicare and Medicaid than they get paid to sell them to comparable government agencies abroad. So we're going to see some litigation, but I don't know that necessarily the courts are more conservative. The Supreme Court is going to stay in place. It's not going to be court packed. So we have a potentially very pro-business court, but I don't know that the conservative justices necessarily feel that the government ought to be required to pay top dollar for drugs. I mean, I don't think that's necessarily what the Federalist Society kind of stays up at night worrying about, right? They don't want the government, their view is you're going to sell something to the government, you're going to pay the price the government wants to pay, right? They don't want the government interfering in how two private parties transact. They don't want the government, jamming through big tax increases without due process. I don't know. Yes. Bottom line, drug price reform in some form is coming. For the rest of the sector, I think they're feeling pretty good, and rightfully so.
So you would, if you saw under the Obama administration for those 8 years, the drug stocks, the pharmaceutical stocks did very well during that period of time. And the last year or so, they have not done so well under the Trump administration with his saber rattling of lowering the prices. Would you see that next year drug stocks could do better as a result of the easing off of the pressure to lower their prices? Or do you think that pressure remains?
Absolutely remains. I mean, Biden's been a long time, advocate of drug price reform. It's bipartisan. I think the question is, it's how much, and it's a fight. And pharma industry is very powerful and effective on Capitol Hill. I would never give them up for dead, and we're absolutely not saying that. But I think that there is some form of that is going to continue. Whether it's going to be the particular policy preferences of Trump's advisors or some new or variant policy that might get some advocates in Congress, I don't know the parameters of it, but something I think is going to be. It's one of the things that I believe that they think they have to deliver on, in some respect.
Okay.
But the outcomes that are the hypothetically worst outcomes, they're probably protected against.
Okay, well, thank you for that. Maybe we can go to the next slide, and then Richard, maybe you could give us an update on PG&E, which, as our little subscript says there, you correctly called in last year's conference. You recommended the purchase of the stock, which I thought was a very aggressive recommendation at $7.94, and here it is today at $12.69. This is the pre and post bankruptcy stock, because they never really dismissed it, and the stock is up 60% in 1 year. So congratulations to you on that call. And can you tell us how you see the landscape going forward for PG&E, and just anything else you want to talk about on that bankruptcy?
Well, it was very volatile to begin with, so it wasn't an easy ride to the 60% gain, and it's not for the faint of heart. I think 2020 is certainly the year where every investment was distressed for a moment or two, and we probably all experienced that. But finding hidden value in these distressed markets is really what the challenge is, and I think everybody that is part of the panel and part of this conference loves and is addicted to. A better explanation on, I'm optimistic on PCG. As a trading mechanism, I would be long. I'd continue to stay long, but this is a pretty good dovetail into First Energy and Energy Harbor.
Okay.
And as people are seeing bad behavior, questionable behavior in various utilities, I don't know how many people are familiar with First Energy or Energy Harbor. What I focus on specifically is the Energy Harbor. Say the equity does trade, ENGH, and they have a very good business. They have a fixed balance sheet. Their retail business is quite wonderful, and the stock is trading in the low 20s. I think it is a double.
Energy Harbor, you're saying?
Energy Harbor.
What's
yes.
the ticker? What's
ENGH. It's right here on our slide. ENGH, that's the symbol.
All right.
And the issue with First Energy, well, there's really nothing new that happened here that hadn't happened at Con Ed in Illinois. And if you remember, that ultimate judgment was a couple of $100 million, and they got on with their life. I can't see the regulators fining First Energy much more than that, because they're not looking to hurt the ratepayers. And the bigger problem is, if First Energy becomes a junk credit, the cost of capital also hurts the ratepayers.
Yes.
So,
Richard, it already has, and the bond market has shrugged it off so far. They have three downgrades. They're at BB+, BB+, BB by the agencies, and spreads are barely wider than they were.
yes, it's amazing. It's amazing. So, I mean, I think this will drag out in the courts, but there will probably be a slap on the hand. They are looking at Larry Householder. He is the chairman. In fact, he just recently got reelected by a nice margin. He says he disclosed everything. Well, maybe some of the things he disclosed aren't best practices, and we'll have to learn from that.
It's hard to see. It's hard for me to see how when you build a nuclear power plant, which is what I understand the action stems from, how anything can be covered up. I mean, even if you're trying to cover it up, there's so many parties running around.
So Steve, I'll say in the spirit of full disclosure, our clients were members of the First Energy Solutions Official Committee of Unsecured Creditors for a year and a half, and we sold $7 million of our Energy Harbor stock 2 days before the arrests at $35 a share. So I was pretty happy with that. Although of course I had no information, we just we felt the fair value had been reached, and God once again showed how much better it is to be lucky than good, or how it's best to be both. Something to think about, right, is the subsidies that are alleged to have been procured by a bribery scheme, right? They're without those subsidies, it's questionable whether Energy Harbor can operate its nuclear power business, and the value of the Energy Harbor enterprise is limited. I feel the stock is dangerous at 20 for a lot of different reasons. It has no liquidity. It has an incredibly chunky holder base. And if one of those holders decides, hey, we can't be involved in this anymore, or frankly, we were involved in the restructuring and it's best for us to divest ourselves of this interest, it could be a single-digit stock without any problem. It's one block trade away from being at $8 a share. What's more interesting in this drama is its former parent company, First Energy, FE, right? Its bonds have been knocked down 1 to 2 notches from low investment grade to high investment grade. Spreads are a little wider than they were before the arrests in July, but not hugely so. The stock, right, is off $8 billion in market capitalization from where it was pre-news, and is off $15 billion in market cap from its highs of the year. And we really need to think about is one, they don't rely on these subsidies. If the state of Ohio says these subsidies are gone, it doesn't affect FE one bit, because those are subsidies of Energy Harbor, its former subsidiary. And while FE is alleged to have been integral in the bribery scam, what is the level of fines? And Richard, you made an amazing point about how you don't want to hit you don't want to hit the ratepayer, and effectively that's what you might do. Is there any possibility that the fines and settlements that FE is going to have to pay are going to be $8 billion? I think the answer is probably not. This is a potentially tremendous opportunity if you're interested in owning regulated utilities, to pick one that is lower. And the market is telling you that the downgauge to junk has not changed the cost of capital of this company. So the thing you really worry about as a utility shareholder, which is, can you get cheap debt? The debt's damn cheap, and the debt market appears to have shrugged this off entirely, perhaps correctly. Now, the question for me on FE is a point of entry, right? They haven't arrested and indicted the former CEO who's been fired, right? Is there another regulatory or criminal shoe to drop that creates an even better dollar price point of entry? But those timing factors are always hard to pick. But I think that's an interesting delta. And here's the crazy thing: FE market cap off $8 billion. Energy Harbor's market cap is only off $1.3 billion, right? And that's an odd disproportion from the primary, victim of kind of the worst case political scenario. And so it feels like there's a significant opportunity in that structure, or if not now, very soon.
But it sounds
with
like you're saying
5% equity dividend.
Oh wow!
They haven't cut the equity dividend, so you're right, Matt. They did replace the entire C-suite.
But I think the C-suite hasn't been arrested yet. So So I guess the only thing that would make me anxious about buying into FE at this level is could it be $5 cheaper, on the day that those guys are perp walked,
So
down to the courthouse, or wherever.
Let me just jump in here because we got about 2 minutes. Richard, are you a buy, hold, or sell for either First Energy or Energy Harbor? And Matt, I'm going to ask you the same question, but Rich, you go first.
Final word, always be investing.
No. That's not my question. On First Energy or Energy Harbor, are you a buy, sell, or hold on any of those two?
I would be a holder.
You'd be hold. And Matt,
Yes.
how about you? Buy or sell on First Energy or Energy Harbor?
Gun to my head, I'd be a buyer of First Energy and a seller of Energy Harbor.
Okay, great. All right, so let me just ask Megan if there are any questions for the group, and if not, then maybe we'll just move into wrap up. So looks like we're okay. So move to wrap up. Okay. So let me just at the one stock I did want to talk about, or one situation, Exxon Mobil. They came out yesterday, I guess it was, say that they're cutting their exploration and production budget. I think there was some slight negative reaction to that. I actually view that as a positive, because I think what it basically signals is that if there's going to be more regulation on the fracking and oil production industry, it probably means that the marginal players, I think of the company I helped co-found back in 2003, Westside Energy. We could never have stood up to a difficult regulatory market. We would have to sell our good leases. And I think ExxonMobil should be one of the ultimate winners of a contracting industry, as they'll just pick up cheap production or producing wells, probably at a discount. It'll be easier for them to buy producing production than to go explore for it. And I think I think Richard would agree with that.
Well, I'd like to add, Steve, that's a very good point. As a fly on the wall on the Exxon boardroom, do they know that it's cheaper to buy than to do it themselves? Or do they see something on the demand horizon that we don't see? Or are there existing production? Can those wells with new techniques and innovations be more productive? And I really hope that's the case, and that they will use the excess capital in moving slowly into renewable energy, of which they have a real business.
Yeah, and we'll see how renewable energy holds up. I mean, I think right now the solution is going to be liquefied natural gas worldwide, but I suppose if we put windmills, and we don't mind losing eagles and birds and condors, that'll work. And then the solar panels, you need a big footprint to generate the megawatts that you need. So we'll see. But I think we're going to hit our budget on time perfectly if we could end it right here. Megan, I guess I turn it over to you. Is that how this works?
I'm going to take it, Steve. Thanks. This is Josh Sussberg. Thank you.
Josh.
Thanks, Matt, Gary, Richard. Very much appreciate the conversation. I think that was super informative and enlightening. So thank you all.